Markets around the world have been in free fall, but did we just witness a massive trade coming in near the lows? What is Wall Street up to, and how could it matter for us as traders and investors? In today's video, we take a look at the second spike in volatility ahead of April the 2nd, what's going on with dark pool liquidity, and more importantly, where the options flows are starting to appear. As technology stocks and semiconductors both make new lows, could this be the trap that all the bulls have been looking for? Join us today as we go through what you need to know about markets right now. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the big data that you need to know, and of course, the key levels. While the market was rallying and we did see some massive trades, it was a little bit more defensive. Financials up, healthcare up, and obviously consumer defensives themselves, but not necessarily the biggest tech stocks. While they did come off their lows, did we see enough buying to make us convinced that this possibly is the low in these markets? Well, there are some traps, and we'll talk about those later in today's video, but let's start off with some data from Jason Gottfried when it comes to a negative market being coupled with a positive end of the day close. Yeah, you would think it's pretty bullish, but actually he found that when you went back through history at other periods, some scary periods, by the way, 2022, 2008, and of course the dot-com crash, often showing these, that while we may get rallies off them, they tend to also fizzle out a little bit over the next 1 month, 2 months, and then they come through. Now, why is this important? Well, it does sometimes depend on who is the president. Often in Democrat-led parliaments, we can see here that we often do get that kind of more bullish statistic versus Republicans, which often bring change. And obviously there are some negatives here. Now, is that enough to go off? Well, of course, it's not generally the way that we like to look at it. We like to look at the price action itself and understand where are the strengths and where are the weaknesses in the markets. And obviously, if you are to get a proper rally in these markets, we can't be continuing to see the rotation that we have so far in 2025. Market defensives such as healthcare, utilities, and staples, these have been some of the best performers. And this suggests what we call a late cycle market. The problem with that, if you're an index holder, is that, of course, the biggest part of the index is the technology sector. And you can see here that when you're looking at the S&P 500 communication services, information technology, or semiconductors, they all made lower lows on Monday and last Friday. And that signals that we need to see a very strong bounce with a lot of flow coming back in. The good news is we did see a massive transaction near the lows, and we'll talk about that soon. So let's go over to what's going on with retail sentiment and I would say semi-sophisticated investors. Of course, most people are horrendously bearish right now. Now, why is that? Well, it's a mixture of the media, the news, and just generally confusion. And as we've mentioned on this channel quite a lot, make sure to subscribe if you like this type of content. 2025, we expected it to be like this. 1 year of 20% plus gains, 2 years of 20% plus gains generally creates a very sporadic style year 3. And of course, with all of the information and all of the news coming out, you really need to have no emotion this year. It's one of the big things that we believe will make you a better investor and trader. Now, what are some of the good news points? Well, of course, we did have a rally just recently that rallied up around that daily 200 moving average on the NASDAQ, one of the most important levels to be watching, by the way, guys. Daily 200 NASDAQ, break above that will be a very bullish sign in the future. But you'll notice that we do get some interesting stats around the 2 months later when we have Q volumes like this, and we get some pretty good stats when you're looking at 3 months. What is this suggesting? It's suggesting that we're forming an area here where there's a lot of volatility both ways, a lot of possible issues. We've got non-farm payrolls, that's the jobs numbers coming up this Friday, and obviously we've got April the 2nd as well, Liberation Day, which we are not sure whether that's going to be a buy the fact and sell the rumor kind of situation. Now, why this is important is because, of course, we are looking for volume, we are looking for statistics to show us that the markets can potentially find base. One of the big things about this recent sell-off is it was the 5th fastest in history. Yes, that's right. If we go back through recorded history, it was the 5th fastest, and that's a pretty damn serious deal. Now, when we're taking a look at tariffs over time, of course, there are some things that we can look at back from 2018. A lot of people don't like this chart, but I think it's interesting to note that when we look back at 2018, we actually had an S&P 500 bottoming at around April the 2nd, which I think is just wow. Is that a coincidence or what? I don't know. We'll find out very, very soon. But still, April the 2nd. And if you overlay them, which we've done over on X, you can see here, links in the description down below, you can see here that we do tend to find this kind of overlay showing us that maybe April could be positive. And there are some reasons. We've got earnings just around the corner. Sometimes tariffs can actually create this huge explosion in initial growth and then followed up by, of course, what happened over here, which was not so good. But we can get that initial growth, so maybe earnings is going to be better than the street expects. And do remember, we have general flows coming from the CTAs, we'll show in a moment, commodity trade advisors. And obviously we get, which is momentum funds, and obviously we also get that other big thing, which is buybacks. And buyback season is open as of the stocks actually reporting. And then, of course, it opens soon after that. Now, why does this all matter? Well, it's pretty normal for markets, at least over the last 20 years, and even actually over the last 100 years, to sell in March and rally in April. You may not be aware of this, but April is one of the best stats when it comes to markets, and that we've also been seeing this type of phenomenon with technology before. When you get to a later cycle market, that is probably what we're in right now, with staples, healthcare, utilities outperforming, gold outperforming, silver outperforming, so all those hallmarks of the later cycle. Obviously, financials have performed during the mid-cycle stage. Then you do get these scares, growth scares, usually caused by slowdown concerns. In this case, of course, potentially it's tariffs or something else. Now, why is this all important? Well, in general times, especially if we're looking at similar periods, the 1990s, such as this chart here, or if we see this is from DataTrek MB, or if we see something coming from, let's say, I don't know, basically a 2006 to 2008 period, if you take a look at those kind of zones, we often get flash sells. Now, we did see one last year in 2024, but it wasn't as deep as this one. Generally, these flash sales are over 10%, and they can go upwards of 15%, but they are met with bullish demand. And if they're not, then it does signal a recession. And we've recently talked about how the next 1.5 months of data really matter. Now, one of the people that always produces some really excellent data is Wayne Whaley, and we've shared his data many times over the last couple of years. And as you'll note, that he really likes January. Now, why is January important? Well, there are certain barometers in January. In fact, we failed a lot of them for a good year. That is, we failed the ones that would usually give you a 20% plus year. But we did see an overall positive January in 2025. Now, this tends to lead to some pretty good statistics over the last kind of 35 plus years. Now, why is this important? Well, if we think about it, we've got here a pretty strong 29.4, so 34 years there. And we've also got 2% moves giving us some pretty big stats. Now, basically, this is suggesting that April should rally if all things are considered. And you might say, well, tariffs, unusual circumstances, geopolitical tensions, all sorts of deglobalization and stuff. But there are some good cases. Obviously, we've got tape purchasing, which is the CTAs here, which are heavily oversold and will need to buy up in April. We've got buybacks on the horizon, and obviously it's all going to be about earnings. So we will be covering earnings very soon. And which one's going to matter? Well, it comes back to the Magnificent Seven. Why is the market down so much? It really is semiconductors and the Magnificent Seven. And you'll notice here that the multiple has compressed pretty heavily actually over the last couple of weeks. And in fact, we've gone down now to only being sitting around, well, I say only, about 27 times earnings, which is still really expensive, but it's better than it has been during certain periods. We've also seen margin get crushed a little bit, which obviously can be seen as bullish. Now, what if you're scared of these markets? What if you're saying, I don't want to buy in these markets. I'm scared things are not necessarily going very well. Well, that could be when we start to move towards gold and other asset classes. Now, if you've been watching this channel for a while, you would know that we've been bullish on gold for well over 2 years, and it's been one of the best performing assets. But interestingly, that we're actually seeing so many all-time highs in 2025, and this is actually now the biggest amount almost of all-time highs. And what that can kind of show us is that we might be looking at a significant rally, but also a significant period where you need to be even more cautious. The easiest money in gold is always made when no one expects it, or anything really, any market that is. 2022, 23, 24, less people expected gains. Of course, 25, everyone expects gains on the markets and isn't there. This is now starting to become abundantly clear in gold again. And while this is only two stats kind of points here, just remember everyone's gone bullish gold. And while we still expect to be able to hit $3,600 an ounce, we're starting to get dangerously close to that level. So yeah, it's looking a little bit kind of dicey there. And it also looks dicey when we look at gold funds attracting $12 billion in 2 months and everyone's piling in. Now, don't get me wrong. The trend is still up, but it is extended, as you'll see later on today's video. So we do love gold still. We hope to get higher levels, and we obviously have been looking at silver recently. Now, when you're taking a look at what's been going on here, courtesy of Mike Zaccardi and obviously Fundstrat, you can see here that we've got conference board 1-year expectations, 2-month net changes, both being kind of negative across the board here in recent times. The lowest or biggest decline in conference board expectations in over 40 years. Sentiment is absolutely shot in these markets, and hence why we've been moving down, but can be seen as a counter. Now, one of the things here you can see is semiconductors versus SPY. This is probably one of the most important charts that if we are going to lead out of this sell-off so far, we need to see semiconductors find some strength. At the time of this recording, we are about here in terms of the charts themselves. And why this is important is because if we see a rally off this point and now break past this ratio, all important level, guys, that is going to be a great sign that the bulls are back and that markets have falsely broken to the downside. If we can continue to see degradation in semiconductors, though, and they start to turn even more negative over the last 12 months, that is a really bad sign for long-term growth. When you lose your lead by, a 12-month kind of lagging indicator here, that is going to be a shocking sign. Now, there were some good things that we reported on last week, and obviously since then we made a lower low. One of the good things was we started to see a little bit of action coming into the semiconductors, and that was the largest trade in 1 month. Maybe not the largest trade ever, of course. We've got a bigger one that we'll talk about in a moment, but certainly a big one that came in near the lows. Now, this is important because although we've gone lower after this, we could still see a bounce and regain back to that. Remember, most big traders, they tend to trade in clusters and they tend to not really care about stop losses. They don't have stop losses. They position in and they position up and down. So when they go in big, you want to see price action start to regain. And that is something that we also saw just recently when it comes to, of course, the S&P 500. A massive trade coming in late last week, then a lower low coming through here. And of course, a regain by the end of the day. Not a bad sign when you've had so many clusters around these lows. We've talked about some of the biggest trades we've ever seen coming through IVV recently. And if price now continues to rally, because remember, if it continues to rally, even though everyone's so negative on it, follow the price action, follow the flow, don't follow your opinion too much, because usually we will have a bias caused by emotion. And this year is one of those times where you've got to be really careful. On the Qs, we also saw a monster, 5th largest trade, big dark pool, plus a sweep at the end of the day. While we do have that stat that says things could be up and down from Jason Gottfried, we also have here a very good signal that somebody is placing down near the lows. Now, you may argue, well, that could be a sell. It's possible, but again, the evidence has been weighing up recently that a lot of transactions are randomly coming through around these prices. And as we know, the biggest funds in the world, they don't have stop losses. So if we do start to see good positive momentum action, you've got to be more bullish. 5,400, 5,475 on the S&P and 5,500 level. These are all very strong zones that we do expect somebody to come and step in, and it does look like someone's starting to do something anyway. We'll continue to track that, so make sure to subscribe for it. In the crypto world, while markets did improve, we'll look at Bitcoin later on, it wasn't really great on the previous flows, and that's because, of course, we saw those hackers start to dump certain positions, and that caused a little bit of concern. When we move over to the flow in rotation, while the markets were rallying, and of course they came off their lows, you can see here some areas opening up really negative, and then by the end of the day, surprisingly, look at XME, it was opening up at -4, ended the day at only -1. That's actually a bit of a rally there. we did see a defensive tact in the market. Staples, utilities, healthcare, they were the performers, even with the rally. And that suggests that it wasn't really a risk-on kind of day. It was a market that is like, okay, we'll just try to buy up this dip, but doesn't necessarily say risk-on across the board. In fact, the last 5 days, semiconductors are now down 8%, showing the concerns over these tariffs and other things. So let's now have a look at the S&P 500 charts. And I've broken this down a little bit so you guys can understand here what we're looking at together. And one of the things that we're looking at here is, of course, the fixed range zones and the most important trade areas. Now, if we're actually just angling in on the recent lows, what you'll notice is we have around 56.64, which was that gap zone, and this 5600, which we find ourselves at right now as being a potential concern for bulls. We really want to see that broken. And of course, I would like to see this particular supply really nailed in terms of markets coming back up. Because if a bear sits here, this is where a bear is going to sit. They're going to sit in this range. And it's very important that we see these levels broken, anchored VWAP, multiple moving averages, and obviously holding these lows. The good sign is that we took the lower low. We obviously found a resurgence in terms of bounce. And that is still, in my opinion, a good sign. This is exactly how the street likes to set a position up. And of course, we have that absolutely critical level moving forward, which is 5,800. And that will most likely, and TA-wise anyway, signal that the low could be in. So if we manage to do some really good recoveries, that would be something we're looking at. Of course, we do have these potential buy areas still open. If we do sell this zone, as we said, biggest small time trade level is literally where we are right now at the time of this recording. A seller is going to try to come in and push the markets down here. So of course, bears still technically in control of this market, even with this rally. And we do know that, of course, here are the options highs and lows. And of course, we know where the options are. Let's actually have a look at that together. And first up, we'll take a look here at the 0DTEs. We know that we're in negative gamma again. We've just managed to resurface above 5,600, which was a bit of a win for the options riders. And the main reason it was a win for the options riders is because they're always looking to make as much money as possible. They push it higher. There's puts everywhere. A lot expire worthless. Notice that 5,600 continues to be the big strike into this week's non-farm payrolls and April 2nd. So we do have a lot of puts now, even some puts that are now in the money. So these 5,700 puts, that suggests to me that if the market wants to make as much money as possible, then it will try to bounce these levels, particularly, the 5,500s and of course the 54s. There are a lot of puts here. And this is, usually where you'll see big market action. If the market really goes into free fall, it's going to create a waterfall effect. And then when these start having to actually be hedged off, which a lot of them aren't at this stage, especially these ones in April's OPEX, all of a sudden you get this huge free fall and you drop these 5,400 levels. That's when things start to get really dangerous. At the moment, we're in the limbo land of just barely holding on to some of these zones. Let's now have a look at NVIDIA. NVIDIA goes back to 110, 115 is most traded zone, and that is now where we go from negative gamma into a positive gamma. So basically, the market's still overall negative, bears still in control at this stage. Of course, 115 could potentially change that. When we look at Tesla, similar kind of situation, 259, 280, 290, 300, that's where the calls sit, and 250 is now the put zone. So we're kind of trapped within a range. 250 is where the buyers have been traditionally. We saw a gap movement. Of course, we'll look at that right now. Speaking of charts, let's take a look. The bonds market, obviously, the overall spread did increase. We already talked about this in our weekend video. That caused, of course, markets to make lower lows, which is not uncommon. The bonds were freaking out. And we're waiting more fresh data to figure out whether these bonds are going to actually come back down and settle. Now, if they settle and price action starts rallying, it's a great confirmation sign that markets are really bottoming in that level. So at the moment, we're starting to see, a little bit more fear coming through in the bonds markets. Yields obviously dropped, not really positive for yields. So obviously yields are dropping. Some people say, well, this means more rate cuts, cheaper financing, all sorts of things. Yeah, I think this is why this week with the jobs numbers, we've got everybody from the FOMC, we've got Jerome Powell, we've got everybody coming out and saying, what's going on, guys? Here, we'll fix it for you, don't worry. Remember, basically the Fed has already said they're going to get rid of QT, as far as I'm concerned. And of course, QE, in my opinion, could be just around the corner. And I think the market will be looking for that. That is a good storyline for the market. Should that happen, it could be a turning point. Obviously, if this April the 2nd kind of Liberation Day thing fizzles out as well, that could be a turning point. We're probably going to see a big move here over the next couple of days, and we're obviously going to see a huge amount of volatility being priced into options. So be aware of that if you're doing it. What about on the macro side for the longer term? Do we see anything good? Well, home builders itself, not so good here on home builders, unfortunately. We do have, of course, a fairly large decline overall in terms of home builders and what's been happening. And this is not a good sign if you're a longer term investor. Obviously, you want home builders to be stable, if not increasing, similar to what we saw. And about October last year, remember before the election, we did have the largest trade ever to be recorded on this ETF go through at the highs. So since then, they're probably pretty happy and smiley faced at getting out of this position and selling it to somebody else. But we do have that lower low. It is a concern longer term. It needs to be considered even if markets go to all-time highs. The volatility of the VIX, which a lot of people use nowadays because zero DTEs broke the VIX a little bit, you can see here spiked up and came back down. But I think the key here is probably to understand that the VIX coming with a secondary spike is not unusual, even if it is compared to a new low on the S&P 500. So if we load the S&P 500 up here, and because the moving average is not going to be that easy to see, we'll change it to a weekly here so you guys get a bit of an idea. What you'll notice is that oftentimes you will get a double dipping event with a lower VIX, even though the initial spike caused that fear. And that's the continuation of that fear coming through. And when you go through history and you really look at a lot of these spikes, you'll get a lot of these. Like you'll have like a spike, it'll take you down. You'll get a secondary spike, it'll form a low, and then often you'll see a recovery. So depending on how this VIX plays, and I would think that it's probably not going to spike to a new high unless April 2nd makes it go wild. This again is normal symptoms of markets trapping shorts in. Let's have a look at the US dollar. Nothing much to report. Still rejecting the 20 on the daily moving average. And obviously a break of this high will create, we think, a bit of upward pressure on the dollar index. It's probably waiting for jobs numbers and April the 2nd at this stage. Gold is bulling. Everyone's bullish. I always hate it when everyone's bullish, but I wouldn't go against gold, that's for sure. Is it overextended? Yes, we are super overextended. Usually that means we're in the bottom of the 9, I guess, in terms of you don't want to usually be buying at these prices, but I'm sure scalpers and day traders are looking at it pretty much and just saying bull. You're not wrong. I mean, the trend is up. There's no reason to be bailing on it or anything in terms of what you're looking at. But when the market starts to decouple and become so extended, obviously just around the corner, bang, there we get that big sell-off. And we kind of saw that recently in copper where it rallied up really fast. Have a look at this on the daily. Rallied up really fast and then just got crushed back down. And that's quite a considerable move. That's 540 down to 5, which in the copper world is quite a lot. Silver still looking pretty strong as well. Maybe not as good as gold in terms of pure money and percentages, but it's still making a series of higher highs, higher lows, and it's not as extended as gold. We are fans, of course, of silver on the channel, have been for a while, and nothing changes on China. China technically came to the first little small time frame buy. We're a little extended on the sell-off here, but we kind of expect, consolidation for a little while after that large move. So not as interesting on that market. Now let's move over to some single stocks. First up, a few of you guys were like, I'm going to buy 250 gap fill. Well, if you did, it was one of those days that kind of worked out for you as long as you didn't have too tight a stop loss. Tesla did fill the gap. It did rally off it. Yeah, I wouldn't take much from this other than the options we talked about before. 250 puts, 280, 290, 300 calls. So basically stuck within that range. The more interesting charts were probably the semiconductors. Let's have a look here at NVIDIA. It wiped the low, which I think is always a key point. And then, of course, we started to see a rally. Was it enough? Well, at least it wiped the low and found a rally, but we didn't really see too much going on here. In semiconductors, it was a similar kind of thing. We wiped the low, we found a bit of a rally, not really enough to go off. The key chart in the future for the swing traders is going to be to break this zone now. We actually have the lower low, so that means that we can now price 0.406 as being a turning point. This is pretty cool if it does happen, but we don't know it's going to happen yet. Of course, we see some stuff going on. We see some large transactions, but we want to see that follow through. As we often say, patience, react, don't predict is the best course of action, unless you like to get a a little bit crazy with the markets, of course, and try to do some prediction early. Now, AMD, another one that filled gap, interesting area. Don't mind AMD on the higher time frame charts. Of course, you can argue both ways when you're saying, well, AMD's overpriced and et cetera, et cetera. But it's at that level where if it's going to find buyers, it should. It did breach, of course, its downward trend line just a week or so ago. Interesting level, still looking at that one. NASDAQ, lower low, obviously regained. Again, problem with it, regained back to previous support. So what's that going to be? It's going to be a resistance. It's not enough to go off yet. Yes, it looks okay. Yes, it's a nice little wick that came through. And obviously we saw those big trades on the Qs. So if we have a look at the Qs here, we saw big trades coming through. But as you can see here, we still don't have enough rally structure to really go off. If you go small time frames, we'll just go back to the NASDAQ for a moment. Look at the 2 hour, a really small time frame trader, someone on a 15-minute chart will be liking this low because they'll say, okay, we've got supply. We then broke down. So obviously that's supply. And then of course we've breached above that, really signaling that we could be finding strength on smaller time frames and a further rallying on small time frame trades. So obviously there's going to be a lot of stop losses down here from day traders trying to predict this low. And I don't blame them. This is around the right point for seeing these fake out traps. Obviously the best actual structure is probably showing here on the NASDAQ in the small time frames. Similar thing on the US 2K. If we have a look at the daily, swipe the low, a lot of low swipes, no higher highs. Something like 2022 might be a good higher high to show that the next session is really ready to go up. And a lot of people are going to look at this and say long leg doji. You know, it's so easy to claim double bottom. It's so easy to claim these things. Usually a bigger trader or someone that's been more seasoned in this will use scaling principles, which is really the big key factor here. Don't go all in. Don't be crazy out there, guys. Try to obviously, put it all in perspective. Now, the final chart here that we need to talk about is, of course, crypto. Bitcoin holding better than you'd think. Something like Ethereum, 1800, it's a low. It's obviously holding sup. So is Solana. So are the others. But Bitcoin came back to its golden fib pocket and it found a little buyer and it obviously has created 2 doji candles. Now, the problem with Bitcoin is it hasn't really been like a standout in terms of the last couple of weeks and months, but you do have 2 dojis. Often that means an indecision point on the market. And of course, we're waiting for that next big move. So one of the things here when it comes to Bitcoin will be, can we get a higher high? And if we do get a higher high over these dojis, that can signal that the markets are going towards further strength. If that happens before the stock market goes, sometimes the crypto market can lead, sometimes stocks lead. The key is going to be tech in stocks, though. We need tech to rebound and rally. Do you think that's going to happen? Let us know in the comments down below. ISM services PMI, you'll notice here on Thursday, something to look at. And the big one is going to be the jobs numbers. And of course, April the 2nd and the announcement from President Trump. So we'll see what goes on there. We'll see what shenanigans we have on the jobs numbers. And whenever I see Fed Chair Powell coming out afterwards, I always know there's going to be some discussion and probably some form of support, you would think, from the Fed being mentioned. I would be very surprised if Jerome Powell's not coming out to be like, ooh, maybe hint a little bit. We'll find out. FOMC members also everywhere around on that session. So a lot of stuff going on this week. Make sure to stick with us throughout. If you're interested in finding out more about what we do, you can check out our 7-day flash sale over at fxevolution.com to find out more about how we pick gold, Chinese stocks, silver, and many, many others over the last couple of years, and how we believe that those things were going to outperform regardless of market sentiment. And of course, you can check us out on X and many other places. Thanks so much for watching, guys. I hope you enjoyed. And remember, the key to this market this year is no emotion. I know that it's one of the strongest and hardest years to trade. We did not expect any differently. The third year after 2 massive 20% backers, that is 20% year on year kind of results, is always a tough one. Up, down, and all around. Be vigilant, be open to things, focus on the next month and a half. The structure matters. We'll talk about it very soon together. Bye for now.